What's going on, guys? MMuniz here. Welcome back to the channel. If you've been around for a while, I owe you a bit of an apology. I wasn't able to make a video last week because my daughter, myself, and my wife, we all got sick with RSV. Now that may sound like RSVP, but no, it's not the same thing. Basically, we got a nasty virus and it was terrible. I'm still recovering, but I'd say I'm about 95%. Now that that's over, hopefully we can get back to our normal weekly schedule. If you're new to the channel, welcome, and this is what we're going to talk about. In today's video, we're going to discuss a covered call ETF called XYLD or XYLD. Now this is a high income ETF offered by Global X, which also offers the more popular income ETF, QYLD. Now more specifically, I'll give you a breakdown of the fund, how it works, what its strategy is, how it's similar to QYLD. We'll go over its performance, and then at the end of the video, we'll talk about my personal opinions on the fund. Now just one thing to keep in mind, this video is not financial advice. These are just my opinions. It's up to you guys to do your own research and determine what's best for you and your family. So with that being said, let's get right into it. So first things first, what exactly is XYLD? Well, XYLD is an ETF or exchange traded fund that sells covered calls on its entire holdings at the money on a monthly basis. What exactly is a covered call? It's basically you selling someone the right to purchase stocks or securities from you at a set price, or what they call the strike price. And there's usually a set time and date where they can execute the contract. So basically the person holds 100 shares of a stock like Tesla, and you sell a contract to someone else that will allow them to buy it in the future at a set price. So why would someone pay money to purchase a contract to buy something in the future? Well, that's a good question. Well, if someone thinks that the S&P 500 is going to go up 5% in the next month, and you're selling an at-the-money covered call option, that means you're setting the strike price at what it's at currently. So they're paying a premium to be able to buy it at the current price today, even though they're going to be buying it in the future when it's worth more. Hopefully that makes sense. So in the case of XYLD, they do those covered calls on a monthly basis, and that's how they generate their income for their investors. So if you're holding this fund, you're going to get paid out on a monthly basis based off of the premiums that the fund receives. And the reason I use the S&P 500 as an example is because that's what XYLD holds, the stocks that are in the S&P 500. So this fund came out back in 2013, so it's been around for just under 10 years. Its expense ratio is 0.6%, which is actually pretty high when you compare it to normal ETFs or index funds. However, for the income ETFs, you're paying a premium because you don't need to hold 100 shares of a specific stock. The fund is doing it for you. It's also saving you the time of doing these options yourself. So it is providing a service to you that other ETFs don't do. Now today, XYLD is going for around $40 a share, which interestingly enough is what it came out with back in 2013. So for the past 10 years, the fund has not gone up in value at all. It's gone up and then it's gone down and up and down. You know, the COVID crash had the most significant reduction, but typically this fund is going to follow the S&P 500, but it's not going to go up as much. It will follow it down. But because of the way that the strike price is set at the money, that's going to put a cap on how much money you can actually increase when it comes to the net asset value. Now, the reason I wanted to point that out, where the fund has stayed the same in net asset value, is because QYLD is the opposite. And one of the biggest complaints about QYLD is that since its inception, its share price has decayed over time pretty consistently. So, looking right here, we're down 35% since inception with QYLD, whereas XYLD has stayed the same. So for someone holding QYLD, is that alarming? Well, that's up to you guys to decide. So the next thing I want to point out about XYLD, and this is going to be really important because people that want a high income ETF that pays on a monthly basis, how much is the dividend? Well, its trailing 12-month yield is 14%, which is very high. However, I want to kind of put a little asterisk next to that because the 12-month trailing yield is actually based off the current net asset value. And in the past year, the net asset value has decreased significantly. So technically the distribution yield, which is around 11%, is going to be a bit more accurate if you were to determine what you're going to get moving forward. So just keep that in mind. Now, you may be thinking, wow, almost a 1% yield on a monthly basis, and it doesn't have the capital decay of something like QYLD. Wow. And it may seem like that, but there's a couple things you got to keep in mind. The big thing when it comes to these income ETFs, and this includes QYLD as well, is if you have a $100,000 investment, and let's just say you've collected $10,000 in dividends, at the end of the year, you're going to have to pay taxes on those. Now, obviously, if it's invested in a tax advantage account like a Roth, you're not going to have to, but if you're in a taxable brokerage account, this is going to be taxed as ordinary income. You may get lucky with return of capital, but Global X has been kind of spotty with that in the past. So at the end of the day, that $10,000 is going to be taxed in the normal income bracket that you're in. So you're not going to be getting the long-term capital gains or qualified dividend tax advantages of other ETFs that give out just normal dividends. So that's going to significantly impact your returns overall. Now this is the same between QYLD and XYLD, but there are some other downsides to XYLD that we're going to get into when you compare it to QYLD. At the end of the day, both of these funds can have a space in someone's portfolio, but I would never recommend to put all of your money into one fund just because it seems to fit your investing needs. You always want to diversify. So even if one of these funds or both of these funds has a spot in your portfolio, just make sure you continue to diversify and not put all your eggs in one basket. So now let's take a look at some of the performance. If we had invested back in 2014 and we had put in $100,000 into each of these funds, QYLD or XYLD, how would we be doing? Well, let's take a look. We're going to go down here. Our final balance for XYLD would be $160,000 versus $159,000, so super close. But one thing I want to point out is you're going to see they follow very similar trend lines, and this is going to be the same if you had looked at an ETF like VU and QQQ. They're going to follow similar trends, but you're going to have a higher volatility or increase on the NASDAQ 100 fund versus the S&P 500. That's just how it works. Anyways, the important part is the income. On a yearly basis, the income that you're getting from XYLD versus QYLD is significantly lower. So you're constantly getting lower dividends or lower distributions on a monthly basis. Now, even though the underlying asset value has stayed the same, we don't know what's going to happen long-term in the future. You know, the problem is if we have a steady next 10 years where we just have an average 8 to 10% increase in the S&P 500, then a fund like this is just not going to perform that well because there's not going to be a ton of volatility in the S&P 500. And when I say volatility, the reason that's important is because the premiums that the fund receives from writing the covered call options is how it pays its investors. And if we go to the Global X Covered Call ETF suite, we can see that back in 2018, 2019, and even the beginning of 2020, look at the premiums here for XYLD, 0.63, 0.66, 0.43. These are significantly lower, and that's why our distributions are way lower when compared to the premiums we're getting from the NASDAQ, 1.6, 2.2, 1.6. Now, this is not what you receive. You receive the distribution, but the fund is getting the premiums, which then it reinvests the excess back into the fund. So overall, QYLD, because of the volatility of the NASDAQ, is getting better premiums, which allows for a better distribution and also better reinvestments back into the fund when compared to XYLD. Now, very recently, the stock market has been all over the place because of uncertainty about rate hikes and all sorts of stuff going on in the world. So yes, the S&P 500 covered calls have been generating higher premiums due to increased volatility, and you can see that right here. You know, but at the end of the day, it's still less than the volatility of the NASDAQ 100, and you know, compared to the QYLD option premiums, that's why you're seeing that. So that's where my issue is with XYLD is, even though it's done well over the past 10 years and it's been just about the same, if not a tiny bit better, at the end of the day, I feel like long-term, if you're going to be holding an income ETF, I think that a more volatile fund is going to pay off better. Now, that's just my opinion. So it's up to you guys to determine what you like better. I mean, if you're holding XYLD, you may like the fact that no matter what, you're not losing money like you are with QYLD. I personally think QYLD is going to go back up in price over time. You know, is it going to reach its inception price? I don't know, but I don't think it's going to zero. Whereas XYLD, I think it's going to stay around the same, and sooner or later, my guess would be that the premiums are going to decrease. So I want to know from you guys, which of these funds do you think is a better investment if you're going to add it to your portfolio? I think some investors are going to find it pretty lucrative that they can get a decently high return, not quite as high as QYLD's, but still very, very high on a monthly basis without that price decay over time. But then I also think that some investors are going to think that they want the higher yield and they want to take a little bit more risk with the chance that long-term QYLD could potentially do better. I'm curious, let me know your thoughts down below. I do my best to answer all comments on all of my videos. And if you're still watching the video, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. With that being said, I hope you guys have a great day. Take care.